Hi, welcome to the class again. So in this chapter, we will talk about how to make capital investment decisions. We learned the different ways to evaluate a project, including the most important one, NPV. But when we are talking about NPV, the net present value, we are talking about a discounted present value of a series of cash flows. But what is the cash flow? How do we calculate the cash flow? This is a topic that we're going to talk about in this chapter. We will first talk about the project cash flows, and then the pro forma financial statements. Then we talk about the operating cash flow and the valuation of the project. The cash flows that should be included in a special in a capital budgeting analysis are those that will only occur or not occur if the project is accepted. These cash flows are called incremental cash flows, always after tax. Be very careful that I highlight the only in the first paragraph. Because in a business, in a project, you will have a lot of cash flows. And some cash flows are related with one project, and some other cash flows are related with other projects. Some cash flows may be occurred even without the project. And we want to pick up the cash flows that will only occur if the project is accepted with that project, to analyze how the project will alter the cash flows. For example, if I want to decide whether to rent a shop to sell women's clothes, if I haven't rented the shop, if the rent, the cash flow, cash outflow, the rent is the cash flow that will only occur if my project is accepted. If I do not want to open the shop here, I do not have to pay the rent. So if I don't want to launch the project of selling women's clothes here, I would not have to pay the rent. But instead, if I have already rented this shop to sell ice cream, then I find that selling ice cream doesn't make a lot of money. And I want to make a decision whether to sell women's clothes. In this case, the rent is not a cash flow related with my decision of whether to sell women's clothes, because I have already signed the rent contract with a landlord for my ice cream shop. So no matter I want to decide to sell the women's clothes or not, I will always pay the rent. The rent is a sunk cost. It will always occur no matter the project is accepted or not. And in the second case, in the latter case, the rent cash flow is not an incremental cash flow. Okay. A positive incremental cash flow means that the company's cash flow will increase with acceptance of the project. The standalone principle allows us to analyze each project in isolation from the firm simply from focusing on incremental cash flows that are only associated with the project. So basically, you want to ask yourself, will this cash flow occur only if you accept this project? Okay. If the answer is part of it, then we should include the part that occurs because of the project. Common types of cash flows. Opportunity costs. It's the cost of lost options. If I want to sell women's clothes using this shop, my opportunity cost is the profit from selling other things. Okay? Not only the ice cream, but other things. Side effects. Positive side effect and negative side effects. It's a benefits to other projects or costs to other projects. For example, if you are running a health company, the company to sell health products. If you also have another company that sells cigarettes, then the second company will have a negative side effect on the sales of your first company. Because if people find that the health company owner is also selling cigarettes, then your credibility of running the health company, the quality of your products, or your company, your corporate image will be hurt. That is a negative side effects. Okay. Changes in net working capital. This is one that we will pay much attention when we go into the tables. So net working capital is defined as current assets minus current liabilities. Current means short term, okay? Present, short term. So the current assets are like short term assets in your balance sheet. If you still remember, in the last chapter, we talked about some accounting basics. The long term assets are called capital. The net working capital means the current equity. Okay, basically it means current equity. Remember that the cash flows associated with the changes in net working capital and the signs are very important. My question: if there is a positive change in net working capital, then the cash flow will be positive or negative. A lot of people make mistakes on this. If your net working capital, current assets minus current liabilities, goes up, is this associated with the cash inflow or cash outflow? The answer is cash outflow. When your net working capital goes up, your money is like cash. It's going down. Think about it. One way to increase the net working capital is to reduce the current liabilities, right? Your current liabilities could be your debt, bond, any forms of contracts prove that you owe other people money. To reduce the current liabilities, you need to retire your debt by paying money. So to reduce the liabilities and increase net working capital, you are paying money. So your cash reserve is going down and you have a cash outflow. We will go to the tables and you will see how important this is. And taxes. Okay. So you have profit. You have profit because you are running this company, and your company can be run. It's not robbed because the police is protecting your property. And the government needs your tax to pay the police. The government needs your tax to pay for the infrastructure, to pay for the education of your employees, to pay for a lot of things. So you need to pay taxes. So avoiding taxes is unethical, but almost every company is doing that. Some costs are not included in the analysis of cash flows. Just like the rent in my previous example. The decision of selling women clothes is not related with the rent if you have already rented the shop because of your ice cream shop idea. So you have already signed the contract. No matter what you sell, you have to pay the rent. So that rent is not associated with your decision, so it shouldn't affect your decision. So to analyze the cash flows of this decision, this project of selling women clothes, you should not include the rent into this analysis. And financial costs or interest is also excluded in our analysis in this chapter. Pro forma statements and cash flow. Pro forma is a Latin term. Latin term meaning for sake of form. It means that this is a hypothetical financial statement that is based on certain assumptions and projections. For example, a corporation might want to see the effects of 3 different financing options. Therefore, it prepares projected balance sheets, income statements, and statements of cash flows. Pro forma financial statements are projected financial statements. They could be designed to reflect a proposed change, such as a merger or acquisition, or to emphasize certain figures when the company issues an earnings announcement to the public. That is, for anything that the company is planning to do, before your action, you should create a pro forma or projected statement of the financial statements to see if this decision is made, if this action is taken. Will my sales go up or go down? Will my tax go up or go down? Will my net working capital go up or go down? Let's think about the decision of retiring some external debt. It will cause some cash outflows, and probably will alter the calculation of your net income and your taxes, and finally the after-tax net income. So it will affect a lot of things, and eventually you want to analyze how this decision will affect your profit, your ROA, return on assets, your stock price, and other things. This is table 1. This is a projected or pro forma income statement. And it's a very standard one. In the income statement, the first line is always the sales or the revenue. Okay. You sell 50,000 units at $4 per unit. So you have $200,000 income, revenue. And the variable cost is $2.5 per unit, and you have sold 50,000 units. So the total variable cost is $125,000. And the gross profit is $75,000. Fixed costs are $12,000. I highlight the depreciation because this is important in the calculation of cash flows. The capital investment is $90,000. It is assumed, okay? I just assume that this is the amount. And maybe it's the equipment, the payment for the equipment, and they can be used for 3 years. For each year, you assume that the depreciation of the value is $30,000. Be very careful that in reality, we assume that $30,000 have been lost in the project's value. So we deduct it. But it doesn't really, the cash flow is not happening. Okay. It's assumed. The cash flow only happens in the first period when you pay out $90,000. So the cash flow only occurs when you pay $90,000 in the first year before this project starts, when you pay $90,000 to buy the equipment. But in the GAAP, the the accounting standard requirement, income statement should depreciate the capital investment smoothly. So if the equipments can be used for 3 years, we assume that $30,000 are lost every year instead of deducting $90,000 in the first year. But in cash flow analysis, we should be very careful. We should realize that only in the first year, $90,000 are paid. And in the next 2 years, no money is paid, no cash is paid. So deducting the depreciation $30,000, we have EBIT, earnings before interest and taxes, $33,000, minus the taxes, we have the net income. The projected capital requirements, it's another table. Okay. We again assume that our net working capital is $20,000. What can be the net working capital? For example, your inventory. Like if I'm selling the women clothes, I first have to buy a lot of women clothes, right? But I'm not really sure if I can sell all of them. But I buy them. I buy them, they're in my store, or they can be in the inventory, and they're my assets. So they're part of my assets. I use the money to buy them. So when my net working capital goes up, my cash flow is going down. This is like what I said before. So what I said was like when the net working capital is increasing because of the decrease of current liabilities. Now I'm saying it's an increase of the current assets because I buy the clothes are assets. So my net working capital is going up, but my money is going down. Net fixed assets. At the beginning, you spend $90,000 to buy the equipment. And we assume that each year there is a $30,000 value lost. And the last row is total investment, which is the sum of the net working capital and net fixed assets. Okay. And these two tables are from the textbook, and it is to show you how to calculate the operating cash flow. The operating cash flow is EBIT minus taxes plus depreciation. Why is that? What is operating cash flow? The operating cash flow is the real amount of money that you receive as owner, you receive at the end of the period from this particular project. Let's go back to table 1. From this income statement, how much money do you think I get as owner, I get at the end of the first year? How much? 21,780? No, you get more. You get 51,780. It is the sum of net income and depreciation. The reason is that the net income is the accounting profit that you get. But actually you get more, because there is a depreciation value deducted from this, but it's a hypothetical deduction. You have already paid for this equipment, so that $30,000 isn't really deducted from your pocket. So your pocket will have net income plus depreciation, this amount of money, and that is operating cash flow. So at the end of the first year, you get this money. Okay, from operation. because net income is equal to EBIT minus taxes. So operating cash flow also equals EBIT minus taxes plus depreciation. And let's go to the formulas. Pro forma statements and cash flow. Capital budgeting relies heavily on pro forma accounting statements, particularly income statements, computing cash flows, and the OCF, operating cash flow, equals EBIT plus depreciation minus taxes, and it also equals net income plus depreciation. This is what we just talked about. The most important one, the final one, well, all of them are important. The final cash flow that we want to calculate, the cash flow from assets, CFFA. The cash flow from assets is operating cash flow minus net capital spending minus changes in NWC, or plus the cash flows from the changes in NWC. Let's take a look at the next slide. In this one, there's a website of formulas. In this is zenwealth.com. There are a lot of formulas of this. If you are interested, you're welcome to visit this website. I appreciate that the author of this website, the owner of this website, provides so many useful formulas for free. And table 5, projected total cash flows, CFFA. The OCF is calculated from table 1. Okay. In table 1, the pro forma income statement, we had the net income, we have depreciation, so we can calculate the operating cash flow. And the second one is the cash flow from changes in NWC. How do we understand it? This cash flow is going down. Why is that? Because your NWC is going up. Think about the example of selling women clothes. At the beginning of this project, before everything starts, you spend $20,000 to purchase a bunch of women clothes. So your net working capital is going up, and your cash flow is going down. So you spend this money. Okay? And at the end of the project, assuming that the project lasts for 3 years, at the end of the project, the cash flow from changes in NWC is $20,000. This is assuming that at the end of the project, you still have this amount of women clothes. Some are being sold, and you make up the supply by buying more clothes. And at the end of the project, you sell all of your inventory and for cash. So your cash is going up. And during year 1 and 2, there is no cash flow from changes in NWC because NWC didn't change. Okay. It didn't change because we assume that your store's space is the same. So you always buy these amount of women clothes. Okay. Maybe different women clothes cost different prices, so this is just assumption. Maybe you can think of maybe ice cream. Okay. You sell some ice cream. You use money to buy some ice cream. Yeah, you sell some ice cream. You make up the supply, and to keep a constant number of ice creams in your store, they keep selling the ice cream. At the end of the project, you sell all the ice creams for the money. You clean up your inventory for cash. So you got a positive $20,000 at the end of the 3rd year. And you have an NCS, net capital spending. And this is a spending of $90,000, all the equipments, the decoration of the store, everything. Okay. At the beginning of the 1st year or before everything. So the CFFA, the cash flow, the first cash flow, the operating cash flow is a cash flow from the operation. It's like everything is going on the right track, and if you just operate it, you get the business, you get the money from the operation. But you, in the calculation of OCF, you are not considering the inventory, the net working capital, or the initial like decoration costs or the equipment purchase costs, these capital spending. So taking all of them into account, we can calculate a cash flow, the comprehensive calculated cash flow from the whole project. It is OCF minus net capital spending minus changes in NWC, or plus the cash flows from changes in NWC, which is the first row plus the second row minus the third row. So you will have that at the beginning of the project you lost. I'm sorry, this must be wrong. There should be one more zero here. It should be 110,000. 110,000. There should be another. Yeah, there should be. Let me change it. Yeah. It's this is right. So at the beginning of the first year, you spent in total $110,000. $20,000 to buy all of the clothes, $90,000 to decorate and buy the equipment. At the end of the first year, you earned $51,780, and at the end of the second year, you earn another $51,780, and at the end of the third year, you earn $51,780 plus the money you got from cleaning up your inventory, selling your women clothes, $20,000. So in total, you got $71,780. Why do we calculate this one? Because this is the cash flow used for calculating the NPV, net present value, which is evaluation of the present value of this project. Now we assume that the interest rate is a bit high, at 20%. So the calculated NPV is 10,648, and the IRR is 25.8%. Should you accept or reject the project? We should accept this project because the NPV is positive. We ran this project for 3 years and we earned a positive NPV. That's why we should accept it. Why do we have to consider changes in NWC separately? Because GAAP is a US accounting standard, requires that sales be recorded on the income statement when made, not when cash is received. So there is a gap between the cash flow and the business revenue. That is to say, if I give my goods to you, and you sign the contract, you say like, I'm gonna pay you like in 2 years. Do I record this business in 2 years? No, I record the business now, when I deliver the goods to you, although I receive no money. Okay. So GAAP also requires that we record cost of goods sold when the corresponding sales are made, whether we have actually paid our supplies yet. So if I make the shoes and I buy rubber from the rubber owners, I got the rubber, I produce the shoes and I sell the shoes. I should record all the costs and revenues when I sell the shoes. Although the shoe buyers haven't paid me money, and I haven't paid the rubber supplier's money. There is no cash flow incurred in this whole process, but God requires that we record that the business has happened. Finally, we have to buy inventory to support sales, although we haven't collected cash yet. There are other methods for calculating the operating cash flows. The bottom up is net income plus depreciation. This is what we said. Top down is that you can calculate it as sales minus cost minus taxes. From the income statement, you will see that it is just the net income plus depreciation. Okay. Also, if we consider the tax effect, the OCF can be calculated from the tax shield approach. That is sales minus costs, which is, what is that? Sales minus costs is the gross profit. Okay, and all the costs. All the costs is including the variable cost and the fixed costs. Basically, it's the EBIT plus depreciation. This amount will be taxed. That's why you should multiply it by 1 minus t. But the tax shield is depreciation times t. The reason is that because we record the depreciation loss in our income statement, so our profit is actually lower than our cash inflow. Because our profit, the net income is lower, we pay lower taxes. How much lower we pay? Depreciation times tax rate times t. We paid this amount less. So the operating cash flow should add this item up. Add it back because we assume that we have depreciation, we have the value loss, so we paid less taxes. We paid less taxes meaning that we got more cash inflows. So OCF is increasing because of this, because of the depreciation tax shield. Depreciation. The depreciation expense used for capital budgeting should be the depreciation schedule required by the IRS, the Internal Revenue Service. It's a tax department of the U.S. for tax purposes. Depreciation in itself is a non-cash expense. Consequently, it is only relevant because if it affects taxes. And the tax shield is depreciation expense times marginal tax rate. The tax shield should be added back to the cash flow. Okay. There were two ways of calculating the straight line depreciation. To calculate this depreciation. The first one is straight line. Assuming that you spent $90,000 at the beginning of the project, and the project will last for 3 years, then we'll assume that every year you have a value loss of $90,000 divided by 3, which is $30,000. So you assume that your value is depreciated, of the capital investment is depreciated straight line, evenly spread across the project duration years. And another one is MARCUS. It stands for a Modified Accelerated Cost Recovery System. And it's an updated version of the Accelerated Cost of Recovery System, or ARCUS. Basically, it's not straight line, but it gives you a format for what kind of objects, for what kind of investment, then what percentage should be depreciated from the first year, second year, third year, and fourth year as a guideline. Okay. after-tax salvage. If the realized salvage value is different from the expected book value of the asset, then there is a tax defect. The book value equals the initial cost minus the accumulated depreciation. For example, in the previous example, you have 90,000 initial investment. So the initial cost is $90,000. And each year, your depreciation is $30,000. And for 3 years, your book value should be 0. Okay, should be 0. But if you find that you thought like this value is just gone, but you find that when you are quitting this project in 3 years, the next buyer or someone who want to rent this shop think that your decoration and equipment are useful, and they want to pay you to keep them. And the money that you get from the payment is the remaining value of your initial capital investment. That is called salvage. But it is not the after-tax salvage, because when your salvage value is more than your book value, you get more income. And for this amount of more income, you need to pay taxes for this additional extra income. So this is the opposite effect of the tax shield. Your tax shield is saying like, because you have depreciation, so you pay less taxes. Here is that you have to pay more taxes. So this more taxes part, T tax or marginal tax rate times the difference between salvage and book value, should be deducted from the salvage. Okay, and that is after-tax salvage. And this is an example. Suppose that the appropriate depreciation schedule is straight line, and why is 100? We probably just assume that it is. We assume that it's $110,000 and minus 0, which is the accumulate. So the end value at the end of the project. So the depreciation is this amount, 18,333 every year for 6 years. And the book value is 0, and after-tax salvage is assuming that you have sold this for $17,000, and assuming that the tax rate, marginal tax rate is 40% is pretty high, and your after-tax salvage value should be $10,200. And for the markers, it's will not be covered in the final exam, so I will just leave it for your tutorial. And there are more things, more calculations of the tutorial. And this is chapter, I think in my schedule is 10, but maybe different in the textbook. The most important table is this table, how to calculate the CFFA from the operating cash flow from changes in NWC and NCS, and how to use the CFFA to calculate the NPV. I wouldn't say 100%, but 99% probability that we will include this table along with the other tables. This chapter will be in the final exam. Okay, 99% sure. So you better be very proficient or familiar with this table. And in the next chapter, we will talk about the simulation analysis.